Today we're going to give you a short update on the performance of the funds we manage, some of the key themes we're looking at, and we're going to have two guest speakers, one in person, Mark Fulton, who you've already heard from, or some of you already heard from, and one by video, being one of our directors of Morphic Asset Management, Gerard Manak, who's a world-renowned market strategist, formerly at Morgan Stanley. So, bit of update on our business. We've had quite a lot of change this year. As I explained before, I spent my entire investment career before we set up this business in ethically screened funds management. And my colleague Chad, introduced you, Chad Slater, who I already introduced you to, Jeff Wood, our head of risk and macro. So when we set the business up, Chad and I, had already had a mindset that was very much focused on not investing in bad companies. But about a year ago, we decided to formally commit to an ethically screened strategy again. We are a signatory of what is called the Principles of Responsible Investment, formerly the UNPRI, which is a commitment by a group of the world's leading funds managers to address issues at a corporate governance level and so on. We've also, the Morphic Ethical Equities Fund, the listed investment company, is certified, I've got to get the right word here, certified by the Responsible Investment Association of Australasia, RIA, and we're pleased to say that the Morphic Global Opportunities Fund was, as of yesterday, also certified. The other thing that we're very focused on is ethical giving, so we give a portion of our fees that we earn from the Morphic Ethical Equities Fund to a charity that we've identified as having a great role to play in Australia, which is called Bush Heritage. We'll have a short presentation on the work done by Bush Heritage during the course of this presentation. So, as you recall, when we launched the Ethical Equities Fund, our view is there is no planet B, and we're committed to investing in change. And to echo the words of Barack Obama, who, as the days go past, seems a better and better ex-American president. We're the first generation experiencing climate change, but we're also probably the last can do anything about it. I'm going to take my jacket off. It's warm in here.
Yeah.
Sorry.
Global warming. Half my colleagues are taking their ties off. So on that point, I'm now going to hand over to Mark Fulton, who's going to talk to you a bit about valuing oil companies in the post-carbon world and his summary of his views about where we are in terms of fossil fuel investing and so on.
Well, thank you, Jack. So my background is I've worked in investment banks. I've been head of research in various investment banks. And I've had a great interest in the energy markets and climate change. I worked at Deutsche Bank Asset Management for a number of years, where we did a lot of work on that in New York. And then in the last 5 years, I worked more with the think tanks and NGOs as a consultant, and I'm an investor in Jack's holding company. So first thing I'd say is that I tend to work with people looking for winners and losers in the energy transition. So we're looking for, in fact, very much beyond nudge investment, really. It's like, forget changing them, who's going to win and who's going to lose. Because I think there are big winners and losers within a 2-degree constraint. Because even within a 2-degree constraint, you've still got to use fossil fuels out to 2050. So I'm not going to go into all that, because that's what I spend most of my time on, and the Principles of Responsible Investment was about that, presenting the winners and losers, who was consistent, and so on. But Jack gets me in occasionally to do a sort of a check on what about the overall thesis of divestment. Particularly from a ethical standpoint. You guys are probably in this because you morally believe in it, which is fine by me. I think there's a big moral issue here too, but I tend to be an economist and strategist rather than approaching it that way. We at Deutsche Bank we always said do good, make money. So if I look at it from a divestment, that you've divested from these sectors, is there any economic risk to that? You may not care, but Jack occasionally asks me to talk about it. I often think with ethical investors, they might say, well, too bad, I want to divest because I don't believe in it. And I don't have an argument with that. But is there a possibility that you will face you know, a lot of underperformance or whatever it is in these energy sectors in particular that you divest from, oil, gas, coal. The first thing I always say is divesting from coal is not such a big deal. Pure play coal is a very, very small portion of the world's index. So if you get rid of all the pure plays in coal all around the world, which is almost what all major fund managers have almost done by now, because, you know, it doesn't affect the tracking error at all. So that seems to be low-hanging fruit. Can you do that in the big diversified companies? No, you can't. So you can get rid of the smaller pure plays, but the big diversifieds you're stuck with in their thermal coal. So that's another issue for those fund managers. Economically speaking, though, the thermal coal divisions of those companies tend to be so small in reality, it doesn't really affect the valuation. So then we get to oil and gas. That's the much bigger elephant in the room in this story, because these are big, valuable companies paying very large dividends still, even in these markets. So what happens when you X them? Well, because we've seen this massive fall in the oil price since the peak in 2014, it's been a pretty good run. You know, I mean, if you divested this stuff, economically speaking, you're looking pretty good in relative returns because you were out of a sector under enormous pressure. So that's not been too bad. Individual companies, again, can be quite different, but in aggregate, it seemed a pretty good bet. So the last time I did this update for Jack, I think 40 on the oil price, towards the lows, you know, you could say it was all looking nice for everyone. Now we're back at 60. And the real question is, do we go to spike higher? That's what everyone's talking about. So what you can see is something quite interesting, but it's very early days. This is a bit of a short-term graph of the oil price, the blue, against the energy sector in the yellow. Now, we've got a gap. Suddenly the energy sector doesn't seem to be following the oil price up. Is this sending a bit of a very long-term signal that finally markets are saying, ooh, there could be a real problem here. This oil price rally won't last. This whole climate stuff is weighing on people's minds. You know, have we got an inflection point? Well, you've got to be honest about that by looking at the next chart and say, yeah, well, the problem is that the oil stocks didn't fall as far as they perhaps might have done during the collapse in the oil price. So in fact, what's happening at the moment is oil stocks are returning to something of a long-run ratio to the oil price. But at least they're doing that. So I might argue something like this. When the oil price first collapsed, markets went, oh God, this is just crazy. Don't worry, eventually this oil price is going to boom back up. We'll just hang on in there. You know, we don't have to oversell this stuff. As time has gone by in the last couple of years, everyone's going, maybe that's not such an easy story. Maybe demand is going to peak. Maybe the electric vehicles who drive the oil price. The whole thing on oil will be driven by electric vehicles. Okay, that's it, because that's 80% of the use of oil is in transport. Electric vehicles, including trucks, which is why Tesla's announcement of the truck is very, very important. So, will the electric vehicles kill oil demand faster than the market thinks? Are people now beginning to worry about that? And is that therefore the beginning of a long-term derating? The real test comes if the oil price heads up another $20. At that point, everyone goes, whoa, you know, are we now, what do we really believe? And that's going to be the big test. And going back to nudge, engagement, we're all prepared for that one. It's when the oil companies finally start saying, my God, the game's on again, let's go invest on all these really high-cost projects, which they pull back from, a lot of them at the moment, because of the oil price. If they go again, that's when this whole issue gets really tested, both from a divestment standpoint in terms of economics and from an engagement standpoint. My hope is that people are seeing the long-run peaking in demand. That's the key. It's about demand peaking for oil, for gas, not so much for gas steadying off, and for coal. We think that's happening. We think there are signs of it. And on that basis, we think that the market might be reaching an inflection point. So even if the oil price rallies further and coal prices rally, the stock price reactions may be much more subdued. And when those prices, as they always do, then kick down again, then you can have a much bigger downdraft. So in aggregate, I think divestment economically, against the background of the economics of these changes, you know, has some economic underpinning to it. Within that, though, I still believe there'll be lots of winners and losers, but that's not what an ethical fund's looking for.
Thank you, Mark. I suspect we've got any questions for Mark. We'll save them to the end, if that's okay. Oops, sorry. Please.
Just recently I've been discussing with people about Caltex Australia, and the head man at Caltex has just tried a whole new program for their forward thinking and forward planning for Caltex Australia. And apparently the aviation fuel demand is going to be so big that it will offset what is lost to electricity in cars. And I don't think that you actually sort of mentioned that or covered that.
I don't think that's right. I think I'd challenge that idea that aviation can offset cars. It certainly is an area, unless we start substituting by much more efficient. In the aviation industry itself, though, there's still a long way to go on engine efficiency and new materials that make them lighter and therefore less energy-intensive aircraft. There's still work on biofuels in that area. So I'm not sure that, I've never seen that forecast that I've seen, that aviation fuel could overwhelm the impact of cars. I find that very, very unlikely.
Well,
but I'm happy to go have a look at it.
Well, that's just what Caltex are going to concentrate on anyway.
They might be a short.
I
I might be shorting that stock on that basis. Yeah.
I mean, it is possible, of course, they have a very Australian perspective.
Yes,
and because inbound tourism and outbound tourism is growing so rapidly, their mix of refining is going to be shifted that way. I don't know the details, but that's possibly what they're talking about. They have a choice when they refine oil, whether they refine it to fuels used in cars or fuels used in aeroplanes, jet fuel or avgas.
Well, they only have one refinery now, and that's in Brisbane.
Yeah.
And the other fuel they bring in from Singapore mostly.
Yeah.
Anyway,
it's maybe a mixed change in Australia they're talking about rather than globally.
Yes.
So I'm going to move on, if I can, to trying to get the slides right. So I'm going to now invite my friends from Bush Heritage to briefly go right place. Irene, tell me if I got the wrong order here. I don't work very. Okay, fine. So what am I supposed to do now, Irene? Matthew, thank you. It's all yours. But I should introduce you everybody to Irene. Stand up, Irene. So Irene, not only does she handle all our marketing communications, she also tells me what to do, and she's really good. I've done my wife.
Well, thanks, Jack. My name is Matthew Taylor, and I'm from Bush Heritage. So now we're going to do a bit of a switch now from the world of investing and fossil fuels and try and go to the other side of your brain and talk about how wonderful Australia is and the bush. So as you can see, I dressed up with my 25-year anniversary tie that I married my wife in 25 years and 1 day ago, because it's a rare opportunity to get out and talk to investors like this and share some of the wonderful work we do. And I thought there'd be some good ties on display today. So thank you, Scott, for joining me on the good ties. Normally my attire would be a mixture of city and then putting the bush hat on and getting out into some of these wonderful remote parts of Australia. So my job today is just to very briefly explain where some of the money goes that Morphic have very kindly decided to donate to a cause, which I know is close to Jack's heart, which is looking after our wonderful Australian landscapes. We've got an incredibly mega diverse country here. I expect many of you know this. It's a land of amazing marsupials. We've got egg-laying mammals, the echidna and the platypus, which the Europeans didn't believe existed. They thought somebody had stitched it together. Beak of a duck and tail of something else when it first got across there. But for me, arriving in Sydney in '95, I was just amazed by the parrots. I went, my God, this is a land of parrots. There was lorikeets, there were cockatoos, there were rosellas. It was a magnificent place. And our diversity in Australia is actually remarkable. We've got 10% of all the world's living species living here, and for a lot of them, this is the only place they live. So it's pretty special. But we also know they're under threat. There's an enormous number of things acting against that. We brought in sheep, we brought in cattle, we've altered grazing regimes, we've done a whole lot of stuff that puts a lot of Australia in a severely challenged state. And we're not just talking the individual animals and plants. We've got really important things like ecosystem services which we need just to survive. So as we know, our quality of drinking water supply is just about okay, but if you live in the Murray-Darling Basin, not so good. And that equally applies for the crops that have been grown there. We've got a thing called Insectageddon happening in Europe at the moment. A survey recently in Germany said 80% of all insects have gone in the last 10 years. Now that is a scary and staggering figure, because those same insects are pollinating all our crops. And if we lose the honeybee, we're in trouble. And of course we're losing a lot of vital agricultural land to salinity erosion and so forth. So how are we going to stop that? Well, we've got some slides. Could somebody just push? Wonderful, thank you. That's our job. We believe our job is to protect Australia, and we've got a vision called Healthy Country, Protected Forever. And we've used the word country very deliberately because it acknowledges our Aboriginal custodians of the land who've been here for a good 60,000 years and who recognise that the animals and plants and the landscape and what happens to it and what we do with it are inextricably linked. So we started in 1990. Bob Brown, our founder, had a couple of forest coops near him in northern Tasmania, and they were up for sale. And he looked at this lush rainforest in the Liffey Valley and he went, I can't bear the thought of that being logged. So he put $25,000 deposit down and secured them, and then had the challenging task of going out and raising all the rest of the money, the 90%, which was our early business model. Buy a piece of land and then get people to invest in it. So that is one of the ways we actually acquire land. The other way is we've recognised that that's very capital intensive. So there's another way to influence how we look after our land, and that's to work in partnership. So we do that through Aboriginal partnerships, we do it through other landowners, and we do it by working with pastoralists and agriculturalists. So we've ended up at the present state working across 44 reserves across Australia, and we protect about 6.2 million hectares of land, which is pretty impressive. That's about Sri Lanka, put it in a perspective. Thank you. This map, I know you won't be able to read it or see it, but it's just to give you an indication of the spread of the reserves we have. The red dots are where we actually own a property. The yellow dots are where we have an Aboriginal partnership, and you can see that's mostly in the west and the north. And the green dots are places like Arid Recovery in South Australia, where they're breeding up a lot of the desert fauna, things like bilbies and golden bandicoots and spinifex hopping mice, in order to have safe populations behind the fence, which we can then move across to our reserve and release outside the fence and look after them for the future. And these clouds are our priority landscapes. As you can see, some of them have got properties in them, some of them up here have less, and there's the northern woodlands of northern Australia where we haven't yet found an appropriate property. Our selection criteria, they're not quite the same as the screening that goes in ethical investment, but we have a similarly very scientific process of going across Australia, where are there threatened species, threatened ecosystems, and where is there really nobody protecting that land. So up the east coast we've got lots of temperate woodlands, the Great Dividing Range, we've got the Blue Mountains behind Sydney, north and south, lots of protection. Out in the deserts, very little. It's old rangelands, it's been flogged to death by sheep and cattle, and there's really nobody protecting it. So that means that's a priority landscape for us to try and acquire a property. And we've got some gorgeous properties. This is Charles Darwin Reserve in Western Australia, named after Charles Darwin himself. And our ambassador for there is Chris Darwin, who lives in the Blue Mountains and is one of our wonderful ambassadors who helped us purchase this reserve. That's the wildflowers last year. After a decade of really poor rain, we had a fantastic winter rains, and this sort of dry landscape suddenly blossoms, and you get fields of these carpet daisies, which are just magnificent. This is one of our reserves in Queensland, Pullen Reserve. You may have seen some press about the night parrot, this enigmatic fat budgie, avocado-esque it was described as, because it's a sort of strange green colour. It's a delightful bird, but people had maybe seen it 3 or 4 times in the last decade, last 5 decades actually, so functionally extinct we thought, until a chap discovered it on this reserve, and we acted really quickly and said, that's a really critical bird, we don't know why it's there, we have to buy the land and find out. And part of that answer is it's totally unburnt old spinifex, this very spiky bush you may have encountered if you tried walking through it. So we got some amazing places, and we got some amazing people that actually look after them. Oh, that's very clever. Is that the next slide? Sorry, we go back one. We've got two slides in one showing there. So I want to talk about partnerships. Our Aboriginal partnerships, the Indigenous protected areas cover about 8.7% of Australia. That's a huge amount of land. And for most Aboriginal groups, they've been taken off their land. They've had all sorts of terrible things and dignities put upon them. And they're now living in cities and towns with their young people growing up with no chance of getting that connection to country, which is so important. So one of the things we've been able to do is come to them quite humbly and sit down and say, what would you like to see happen to your land? And invariably, one of the things are, we want our kids back on the land, we want them connected to country, we want to look after the land, nurture it, and we want to continue our tradition of storytelling and be able to pass this on to the next generation. So one of the things we've been able to do is go, that sounds fantastic, because for the last 60,000 years, possibly a lot more, they've been managing Australia, all of Australia. So it's not a pristine landscape. They've been managing it for themselves, but they've been doing it in a harmony and an approach that we could emulate. So we work with them to put a healthy landscape plan together, which allows them to get their young people back on the land as rangers, which we often fund. We'll often fund a CEO position if they need to put together a partnership. And so we eventually work with them, and they can see their lives getting better, and they can see their country getting better, and we can see the conservation outcomes improving. So just as an example, in the Western Deserts with the Buruli people, in a partnership there, we're actually working with them to track the bilby, because we can go out and have one of our ecologists look and go, it's a struggle, I could spend months looking for it. If you take one of the ladies out, they'll sit in the car and they'll be driving along in the back and having a cigarette and talking, and then they'll suddenly go, stop! And they'll leap out the car, they'll go down on the ground and they'll go, good bilby place here. Look, there's the mother and the young, there's the tracks. And they'll just, by some magic, it's as close to magic as you can imagine, it's actually a great skill. They can track it and say, been here, but maybe 2 weeks ago, and there's a fox print as well, so not good for him. But there's an enormous amount of knowledge there that helps us and speeds up the work we do. So in that partnership, we take this twin toolbox approach, we call it, which is getting the best of Western science, which is things like satellite imaging to look at where fire's going and the old fire scars on the landscape, and the traditional knowledge, which is their traditional burning practices, where they have hundreds of different ways of doing fire. So they can do cold burns, warm burns, hot burns. They can do it at certain times of year, and they'll do it in order to protect a sacred site, so nothing ever goes in. They'll do it to create green pick for kangaroos, which they hunt later. Lots of different reasons. But the end result is a mosaic patchwork of landscape, which generates the right sort of habitat conditions for a real wealth of different species. All of this work's underpinned by science. We don't do anything if it hasn't got good science. So just some examples here. Here's a native plant nursery down at our reserve near Breadbow, south of Canberra, where we're replanting yellow box into a heavily degraded landscape. There's a dusky hopping mouse having its ear measured. It's not painful. It's just checking its size of the ears. Let's get our baseline survey work. A couple of undesirables that we constantly have to manage. As you probably know, they're responsible for the extinction of this critical weight range of mammals, anything from about that to about that, which is perfect prey. And they've gone. They've gone from all of Australia. Fire management. This is Aboriginal fire management. And this lovely little chap here is the red-finned blue eye. It's found in one reserve in all of Australia. It lives in a spring in the middle of the desert. So this is artesian spring that comes up. It forms these massive 30 centimetre high pools over maybe half a hectare. And in that 30 centimetres lives this fish, which has been going for an unbelievable length of time, but subject to the threats of an invasive predator, gambusia, which comes and eats it. So we've had to put barriers up, huge barriers, fences that high, to stop this native fish getting in. So we'll finish with a performance graph. 2017 marked the end of a 5-year strategic planning cycle for us, and we're very proud to say that we wanted to get up from 4 million to 6 million over that time in terms of hectares protected, and we achieved that a year early. You can see these are the reserve acquisitions we've made, a big push in these 2 years. So we're now over 6 million hectares protected, either through owning it or through working in partnership with our Aboriginal partners. We wanted to get up to 20,000 active supporters, and we've easily beaten that. And we wanted to increase our overall size, our revenue, to about 20 million, because that's what it takes to actually manage all these 44 properties. So we've been able to do that because of people like you guys. As you can see, most of our income comes from donations for individuals or from people giving us money in bequests in their wills. But increasingly we're getting money from organisations like Morphic, who've recognised that we have to look after the planet if we want our grandchildren to experience some of those wonderful habitats and landscapes there. We also appreciate the fact that it's from investors like you who've decided to invest in an ethical fund that allows the world to actually start to put a bit more focus on the things we need to look after, which we are very happy to do on your behalf. So for that decision that you've all made to invest ethically, and Jack for the decision for Morphic, thank you. And we'd love to see you out on one of our reserves. They tend to be a bit remote, as you can see, but we've got a lovely one just south of Canberra, which we'll look forward to inviting to you next year. And if you'd like any more information afterwards, please come and talk to me. Some annual reports here that tell our story. Thank you once again.
Well, to that point, we had a meeting with Matthew and Chris Grubb, his chairman, yesterday, and Irene and I are going to work on a plan to try and invite investors in our funds to come and join us for maybe a couple of days away. We'll have some discussions about investment issues and maybe go and plant a few trees. That's a plan underway, but it's a part of our engagement. So, okay, so now we're going to come to the business to tell you about how the funds are going and what we're doing. First of all, I said this is talking about the Morphic Ethical Equities Fund. We've had a reasonable start to life. We're up. I think at the end of we put out an interim announcement about our NTA as to the 23rd of November. I think we're up about 9.5% now since we launched the fund, which has been partly helped by a good market, but we're pretty pleased about that. What we're a little bit less pleased about is the discount to NTA, but we noticed that it has started to close in the last few days. The NTA at the moment is, and I haven't got the correct figure here, anybody help me with the exact figures, but it's a little above, as of today, a little above 115. No, I talk about as of the 23rd. 23rd.
115.
115, exactly. I'm hoping that the announcement we made today that we intend to pay a dividend 6 months earlier, we indicated in our prospectus. It won't be a large one, but it's the beginning of the process. In relation to the half year to March, I hope that will start to get a bit more interest in the stock. We've still got quite a few options out there. And we obviously want to get those exercises because that will help reduce the overall cost of running the business a bit. Those options expire at the end of November 2018. For the Morphic Global Opportunities Fund, we've had a pretty good year. I think our rolling 1 year returns about 22.5%, and we're up about 18% per annum since we launched the fund. What that means in rough terms is that somebody who invested $10,000 when we launched the fund has now got about a little under $25,500. We've managed that, and I stress this is one of our key objectives. We always try to manage the money so as to minimise the volatility. There's some questions before about the way we allocate our investments. Volatility to us is very important. We never know when we invest when we're going to need that money back. So it's very important that we don't have too much of this going on, because we need the money when it's here. That's not so great. So the aim is to try and minimise that up and down movement, what is known in investment terms as volatility. Portfolio, as it was at the end of October, has changed a little bit, but not too much since then. Our biggest position at that point was in, as I said, a French-listed company called Alstom. Those of you who had to cross George Street today will know all about Alstom because they're the guys who are building the trams. You can't blame them for the incredible mess in George Street. So they're a global rail and tram operator, and they also have do a lot of work in signalling, which is a very profitable business. We now have about 4% of the fund in that single stock because they've recently announced they're going to be doing a merger with their other major European competitor, which is a subsidiary of Siemens, which will make them globally very competitive. But they've never had a larger order book, and we think the stock is very cheap. Turning to something a little bit less tasteful, but still very ethical. We have our second largest investment is a company called Service Corporation, which is America's largest operator of funeral parlours and cemeteries. It's a I hate to say it, but a very steady business, and we think somewhat undervalued. It's not super cheap, but given the very, very predictable nature of its business, we think it's very attractive. And also, I should say that it's a business which is consolidating a great deal. In Australia, we have a similar company which has a much larger market share and trades at a much higher multiple. And we think as they increase their market share, their multiple will increase. Samsung Electronics, I'm sure a few people in this room have got one of their products in their pocket. But actually the major business they have is making the chips that go into everybody's phones. We've recently cut our position a bit here because we did so well from it, but it's still one of our largest positions. A-Team is a Japanese company that does phone games, the games you play on your phone, and also a very fast-growing e-commerce business. And they're now Japan's fastest or largest online bicycle seller. Very innovative company. We've looked very hard at US banks. Unlike Australia, there's a huge number of banks in the US, so we tend to have quite a few positions in these regional banks that not many people have heard of in Australia. Western Alliance is based in Arizona. Very well run business, and because it's so small, even though US banking as a whole is not growing, I think loan growth in the US is about 3% a year, a bit like Australia, very low. Because they have all these smaller players who can grow rapidly with very innovative business models, these guys can grow even though the big guys aren't growing. And in fact, we have what's called a long-short strategy. So we are long a handful of high-growth, high-quality, smaller banks, and we are short Wells Fargo, which is an ethically challenged, very large bank that really can't grow because it's so big, and also has the problem that I don't know if any of you have been reading about this, but if you think we have problems in Australia with some of our banks, we have to have a banking inquiry. Wells Fargo's been much naughtier. To give you an example of their naughtiness, they opened bank accounts for people who didn't want them without knowing that they'd been opened in their name. They cheated them on their insurance, on their homes and cars, and a variety of other things are coming to the surface. Because what we find with when things go wrong in companies, what's called cockroach theory applies. You know, one comes out, and you can be pretty certain if you see a second one's going to be a whole lot more out there, and that's where we are with Wells Fargo. We are very active in Japan. So one of our other large positions is a company called Open House. It's a property developer in mostly in central Tokyo, but increasingly outside Tokyo as well. Very fast-growing company, incredibly well managed, and somewhat unusually for Japan, very focused on investor returns. And I'll talk a bit more about that company, one of our short positions we have, which is funding that EDA group in a minute. And I won't go through all the rest of them, but that gives you a taste of the kind of companies. We tend to invest in more in mid-cap companies. That's companies above 400 million US in market capitalization, but not super big companies. I'm going to briefly talk about why we're enthusiastic about Japan. As many of you will know, the Japanese market has had a tough time for a long time. In about just how many years now? 28 years ago, is that right? Not yet. It was actually the exact date was if you were a stockbroker in Japan and you were taking some time off between Christmas and New Year, 1989, you thought you ruled the world. The stock market in Japan peaked on December 27th, 1989. By the way, they're all working days in Japan. Japan works on Christmas Day and on New Year's Day, so there's no rest for the wicked. Anyway, so at that point the stock market peaked, and it's still, I think, something like 30% below that peak of nearly 30 years ago, to give you an idea. But within that there have been periods when Japan has been a very attractive period to invest. And we think this is probably the beginning of a fairly long recovery cycle. Put it in context, and Jeff's very good on this stuff. Generally, what Jeff was pointing out to me the other day was that generally markets, when they go up a long way, and for many years, they take almost as long to reach their bottom afterwards. So Japan, the stock market in Japan reopened after the Second World War in the early 50s, and it had some what seemed like volatile times at the time, but a pretty steady rise through to that 1989 high. It's now been declined for a very long period, and we think when it bottomed out, we think it's now on a long-term recovery. Why is that? I love Japan. I've been there many times over the last 30 years. Joanna lived there for a while, I think. It's an amazing place, but there's something about the Japanese culture which means it's quite resistant to change, and so it reached the point when it absolutely has to change. And the best example of that was what's called the black ships. That's that picture here. So in the late mid 19th century, an American gentleman called Commodore Peary turned up with these incredibly modern warships, which were known in Japanese terms as the black ships. And the whole of Japan, which had been basically asleep for 300 or 400 years, that's how long they were asleep for when they decided to close themselves off to foreign influences, realized that they had a choice. You could get colonized, or they could reinvent themselves to change. And the result of that shock of seeing the extent of modern naval power, the Japanese economy or the Japanese political system reinvented itself. There was something called the Meiji Restoration, which saw the whole modernization of the economy. And from that point onwards, Japan had an incredible run of reinvention, and were a very successful modern country. So by the end of the First World War, to give you a bit of historical background here, Japan was carrying about 40% of the whole world's shipping at the end of the First World War, because they'd modernized their shipping fleet so much. Everybody else had been a bit destroyed by the First World War, and although Japan was as many people may not know, Japan was actually an ally of Australia during the First World War, had warships in Darwin defending our shores. But Japan had become an incredibly successful country. Obviously, it lost its way economically between the war period, and obviously got destroyed during the Second World War. But it needs these shocks. Now, what's the shock that's turned Japan round? First of all, there was a political shock at home. After the bubble burst in Japan, I remember going to Japan in the early 90s. There were homeless people living in the parks in central Tokyo. That was how bad the shock was. That's cleared up now, but the next shock is that Japan is facing a very resurgent neighbour, China. And the current Prime Minister of Japan is a nationalist. He's very worried about Chinese domination. So that's why he's realised he's going to make changes to restart the Japanese economy and get the place going. And I think that's what we've seen. So Prime Minister Prime Minister Abe has been very focused on doing some very important stuff that will, I think, make Japan a much more attractive place to invest. On the left-hand side, you can see a chart showing the impact of some reforms done to governance. Remember, we are what's called an environmental, social and governance focused fund, and so we're very interested in this stuff, and we think it's very much connected with a better performance for stocks. So since Prime Minister Abe was elected in 2012, he's made dramatic changes, or he's overseen dramatic changes to the way that Japanese companies govern themselves. And some of those key points were introduction of an index that would only include well-governed companies, or better governed companies, I should say. Introduction of a so-called stewardship code, which meant that investors in companies agreed to try and nudge companies into better behaviour. And then more recently, a corporate governance code, which basically requires companies to have more independent directors, more foreign directors, and in many cases, their first ever female director. And that's having a dramatic impact. So you can see that that now you'll find almost no respectable company in Japan can no longer have no female directors at all. They almost all have some independent directors. I think this is all very exciting stuff. By the way, one of the things I'm very excited about Japan is female empowerment. Years ago, Japan used to have very low female employment. Women left work at the age of 25 to get married, or by the age of 25 to get married. Now, the Japanese participation rate in the workforce in Japan is higher than the US. So there's a real change, and I think very much a benefit for Japan. One of the effects of this is that Japanese companies now realise that to justify their place in the world, they have to have a higher return on assets and on equity. And so you can see that the number of companies who recognise they need to look at this stuff has gone from a scarily low number, in my view, in 2014 of about 30% to well over half today. So that is a really big change. And there's an old saying that Warren Buffett, who's a great investor, has, which is incentive to create outcomes. The incentives now for management in Japan are changing from let's keep our job, let's keep all the employees' job, to actually get returns for our investors. Our current positioning in Japan is a mixture of longs and shorts. It's by far our most overweight market. I've discussed some of these stocks before, but you can see we have got about 15.8% of the fund in long positions in Japan and about 6% in short positions. And there's a wide range of companies from e-commerce style companies to construction companies to companies who are doing things like digital marketing. Example of how I want to give this example of how we look at investing from a long-short perspective, but in this case in a Japanese context. Soon after we launched the fund, we thought it would be an interesting opportunity to look at all the companies that had no broker coverage in Japan, and a surprisingly large number of Japanese companies where no broker covers them at all. And the one that stood out to us was a recently listed company called Open House, which, as I said, is a Japanese home property developer. They have a very unique business model. Their primary business is taking rundown housing in good locations, knocking it down and building a couple of townhouses on it, which they're very good at. Japanese housing typically only lasts about 30 years. It's built to last 30 years and then they rebuild it. So we really like this company. It pays dividends, which increase almost every 6 months. It buys back shares when its shares are too cheap. It's got a young board, and it's a going places company. We decided though that although we were pretty confident about the outlook for Japanese housing, we saw there was an opportunity for us to really just invest in the excellence of this company and take out all the risks associated with being in Japan and being in the housing development business by shorting another slightly or fairly similar company called IDA. And now IDA is a classic example of where governance has gone wrong. We looked at this company for many years. It used to be 6 separate companies that were all essentially founded by one patriarch, and then he gave his sons, I notice the word, and I stress the word sons, a chance to run all these subsidiaries that were sort of partly owned as a real corporate governance nightmare. About 3 years ago, he became unwell, and you could see the end was nigh, so he decided to bring all the companies together, but he had absolutely no faith in any of his sons doing a good job running the business. So he did a very typical Japanese thing. He had a daughter as well. His daughter was instructed, and I'm probably being a bit too literal here, but was encouraged to marry one of his most promising executives, and he was given the job of running the overall company, the new merged IDA group. Now, this is I spent a lot of time reading non-investment materials, and I read a great book which about sociology of Japanese businesses. What happens under the hood. And one of the fascinating things I learned in this book was that this process of getting a daughter to marry a great executive when none of your sons are particularly good at business is quite common. However, normally what happens is that you then adopt that son-in-law and he takes your name. But that has to have the consent of the whole family. So the really telling point here was that the chief executive of the IDA Group did not take the family name. The family did not consent to him taking full control, even though the father had given him the top job. And so what we now have is 6 subsidiaries of a holding company, all run by the sons, doing whatever the hell they like, while the parent company can't control them, which is not a great scenario for investors. So that's why we're shorting the stock, and in fact it's underperformed quite badly. So to give you, that's a bit of background about how we look at long-short investing, the kind of factors we look at. One of the things that makes our fund a little distinctive, and my colleague Chad has been in Europe recently marketing, and what we've discovered is we're one of the few, I'm not going to say the only, Chad, but it's close to that, isn't it?
We are actually the only.
The only long-short ethical fund in the world. I'm going to be very cautious about that, more cautious than he is, because I'm older and more experienced and get caught out in these things more often. But we're certainly one of the few. And we're also, even more extremely, we're one that we know we're the only fund that has a business mandate actually taking the opportunity to short bad things. We discussed before the idea that we obviously can only invest in things that aren't bad, and we try to invest in something that's actually good, but we also short bad things. And one of the things we've identified as a company that we short, and we only ever do this stuff to make money for investors, to be very clear about this, is a company called Prada. Now, I'm not going to ask who in this house, who in the room here has got a Prada handbag. I'm sure none of you would admit to it anyway. But Prada is actually a very interesting company. Prada is an Italian company, but for reasons that we think we understand, it chose to list in Hong Kong. That partly reflects slightly worse corporate governance standards in Hong Kong, and partly reflects the fact that its key market is in Asia, so they wanted to be listed in Asia. It's not going very well. The company's got its earnings, its expectations of earnings is continually declining. That's called falling EPS revisions. But there is, we think the share price, which is pretty expensive, is assuming that it turns around. We think it's unlikely, partly because it has very, very poor governance. So the promoters, the founders of the company, get overpaid, in our view, a lot. They engage in a lot of related party transactions. So, for example, they own, this is a combined manufacturing and retailing business, but a lot of the retailing is franchised, and they actually own some of the best franchises. So they're getting it both ways, so to speak. And we don't think they're any independent directors. And that is really shown in the share price performance, which is, as you can see there, since November 2014, has been pretty well negative. I'm now going to hand over to a video, and I might have to ask Irene to help me here, because I've no faith in my capacity to make this work properly. But I mentioned before, we're very lucky. We have a very, as a business, we have a lot of supporters who are very experienced. Mark Fulton, you've heard from. We also have, as one of our directors at the Morphic Asset Management level, Gerard Menac. And Gerard Menac was kind enough to let us film him to give his views about where the world is headed. They're not necessarily exactly our views, but we're very grateful for having his input.
My name's Gerard Menac. I'm on the board of Morphic Asset Management, and I'm here to give you some thoughts on the outlook for the world over the next 12 to 18 months. I should say these are my thoughts, and the team at Morphic can at times disagree with me. So what can we say about the next 12 months? Well, the first thing is the world's going to start 2018 with the best head of steam we've seen for probably 6 or 7 years. Global growth in 2017 has been shaping up as the best year for global growth since 2010. Although if you look at my first slide, which shows global trade volumes and also corporate sentiment globally as measured by the so-called PMI, or Purchasing Managers Index, yes, they're both at the strongest or highest level since 2010, but it's a fairly low hurdle. The world has been through 4 or 5 fairly mediocre growth years, so to say it's the best for 5 years is nice, but not as strong as what we saw through the last cycle. Nonetheless, better growth is feeding through to earnings. So my second point is corporate profits are up, and we've had a cracking year for global equities in 2017. My view is that we'll be able to maintain that momentum at least into the early part of 2018. It is worth noting, however, that what were expensive markets at the start of the year have got more expensive through the course of 2017. My second slide shows a global equity index, the MSCI All Country Index, and earnings for that index. And as you can see, both of them have curled higher this year, but as you can also see, since the lows of late 2016, global equities are up over 40% at a time when earnings are up less than 20%. So yes, earnings have been supportive for equities this year, but the gains in the market have far outpaced those earnings. So as a result, we've seen expensive markets get more expensive. So far we've got a good global head of steam going to next year. We've got earnings responding. We've got markets getting more expensive. The third point I'd make about the outlook is I think we continue to see a reversal of one of the big trends that we'd seen since the GFC. The big trend we'd seen since the GFC in global equities was the outperformance of US markets versus other markets. Now my next slide just compares earnings in those two markets, the US and the rest of the world, and you can see this is an obvious reason why the US has been outperforming. US earnings have made new highs perpetually through this cycle since about 2011, whereas earnings outside the US continued to fall up until early 2016. From that starting point, as global growth has improved, there's been much more earnings upside potential outside the US. So what we're finally seeing is non-US markets outperforming the US market if you look at the performance in common currency terms, which is how most people tend to measure them. And my view is, while ever the global expansion remains fairly healthy, US will continue to underperform global equities. I'd also have to say though that Aussie equities will probably underperform all the global equities. So the pecking order really is non-US markets, the US market, then the Aussie market. The final point is, are there any clouds on the horizon? Well, there are risks obviously. Some of them are in a sense hard to measure. I have no particular edge on what's going on in places like North Korea or the Middle East. And the way markets typically treat these political issues is they ignore them until it's the only thing that matters. I don't know if we're going to get to that point on those two particular issues over the next 12 months. In terms of the risks that we can say something sensible about, the most obvious is, in a sense, the usual suspect, a policymaker error. Now, in that sense, the main focus should be on the US, where their central bank, the Federal Reserve, is far further progressed in tightening monetary policy than central banks elsewhere in the world. Now, I don't think the Fed will make a mistake in 2018, but I think there's a risk that it'll make a mistake in 2019, and that may be something that starts to weigh on markets in the back half of next year. The key to the risk is simply that the Fed tightens monetary policy too far, and this all revolves around an issue of what's tight money policy. Now, many people, myself included, think that rates don't need to go very high in this cycle to start to impact growth. My own view, for what it's worth, is that anything in the US over 2.5% to 3% on their policy rate becomes an issue for growth. Now, if you look at my final slide, which shows the outlook for interest rates, you'll see some square dots there. Now, these are the Fed's own forecasts for their interest rate. And what they're telling us is that they think they will push their interest rate towards 3% some stage in 2019 and 20. In other words, if the Fed delivers on its forecasts, I think that could become a real issue for financial markets in the second half of next year. So in summary, global growth looks good, corporate earnings are responding, while ever the expansion looks healthy, I think US equities underperform. I think there are better opportunities in emerging markets in Europe. And finally, if you're very far-sighted, you can see some clouds on the horizon emanating from monetary policy makers, and that could be the big story this time next year. Anyway, thanks for listening. I hope you have a good day with the Morphic team. Cheers.
Well, that was Gerard's views. We said at the beginning, he said and we said that we don't always agree, but I think broadly speaking we are pretty much in alignment at the moment. As you've probably seen from if you've seen our monthly performance reports, we are quite underweight the US. We are somewhat overweight emerging markets, and we're somewhat overweight Japan, and we're a little underweight Europe. We're not quite so bullish about Europe as he is. All right, questions?
I am just a bit surprised that there's so much money in for trusts.
So much. I'm so surprised my phone's on.
Yes, so much money invested in for trusts compared with equities. And I just wondered what your thinking is. It seems as though there's 42, nearly 43 million in for trust funds and 15.5 million in equities. So what is your thinking here? And those particular four funds, are they in fact ethical funds or are they index funds? What's the philosophy?
Okay, let me explain that. So basically, those we operate with what's called a mixture of a bottom-up process where we find individual stocks that we find attractive that meet our ethical screens, and we have a top-down process where we're trying to say we think at the moment as we do, Japan's going to do better than the rest of the world or whatever. So what you see in those four ETF funds that you referred to is our top-down view of which countries or areas or sectors are going to do best. Now, in response to the question about the ethical component, we're aware. Sorry.
On the first point,
Yep.
These are all American funds.
They're all listed in America, but they're actually global funds.
Global.
But they vary. Some of them are regional, some of them are global.
So the idea is to get a nice global diversification at this point in time.
Correct. That's right.
And not have to put all the money into individual companies.
That's correct. Yeah.
Identify. And are you happy with those four funds? The way they're performing, they are sort of index funds.
Okay, so they are index funds, but we're not an index fund ourselves. So, as I say, they give us what that means is we get the opportunity to have a view on countries or regions or in some case sectors without having to take the individual risk of company A doing some individual company doing something that does not work very well. So as I say, it's a top-down view about economic factors and which markets may do better than other markets. Now, they're listed in the US because that's the most liquid market in the world and also where we can do it most cheaply with the least cost. So our focus and the choice of those ETFs is to keep the costs way down. But you asked a very good question at the end there, which is probably the more difficult one to answer, which is about the ethical component of the companies in those funds. And in our prospectus, we explained that we also operate what's called a short basket, a basket of stocks which we short, where we're neutralizing the effect of any unethical stocks in those ETFs. And that's one of our largest short positions. And so what we're doing there is we look through the individual. We can look through the individual stocks in those ETFs and work out which stocks would not be investable under our universe, and then we short them out by name in a basket that we had prepared for us by one of our bankers. And so that's how we take out all the unethical stocks. So, for example, let's give the biggest and ugliest probably out there, ExxonMobil. ExxonMobil's in those ETFs, but we take it out by shorting it out by name. So we have a long position and a short position, and they neutralize and they equate to zero. Does that make sense?
Well, I'm afraid I'm just not quite sophisticated.
Okay, let me explain. So in the ETF, there'll be some stocks we don't like.
But there'll be heaps of stocks.
There are heaps, but we identify the ones that are not consistent with our mandate.
And how can you just zero in on one of them and operate on that?
No, well, there's many. But the way it works, when you buy those ETFs, you get given the full list of all the stocks in there. So we identify which stocks in that list are not consistent with our mandate, and then we short those stocks to get rid of them, so they're not actually in the portfolio. On the one hand, we've bought it as part of something else. On the other hand, we've sold it to get rid of it. So net, we don't have it. Does that make sense, or you're still struggling?
No, that's all right. It's very interesting, really. I'm just wondering, with those four funds, the return on them, just out of interest, I know you've only been going 4.5 months, and so everything is just in a chrysalis stage. But with those four funds, are they getting the sort of return that the individual stocks are getting, or in fact better? Because it's an interesting contrast between active and passive. What we're trying to do there is, to, as I said before, is that we know there's basically two sources of performance in a fund. One is the decisions you make about individual stocks,
and the others are decisions that you make about which markets you invest in. So what we're trying, and they're quite different. Sometimes you buy the right stocks in the right market, you win twice, but quite often the success that you think you as a stock picker have had in picking a certain stock, a lot of it owes to the choice of market you invested in the first place, Japan or Europe or the US. So what we're saying, we separate those two strands of performance. One is the top-down story about I choose to invest in Japan, and the other is the bottom-up story, which I choose to invest in, say, Alstom, which is a French-listed rail company, individual stock. We think so when we invest in Alstom, the French, which is our largest position, we're saying we think this stock is going to do very well, but we may not be that enthusiastic about France. So we could, for example, and we're not in this case, we could say we like this stock, but we're worried about the French market. That's why we try and deal with the two issues separately.
So just to get back to my original question, though, the return on the individual stocks, the return, how are they comparing, or is it not comparable?
It's not because there's two. Think about it in terms of two functions we're trying to achieve. One function to try and pick which markets will do best, as in, say, Japan versus Europe or whatever the choice may be. That's one of our sources that we're looking for outperformance. The other is to say, I like this stock, which is a different story, and it's important from a mental clarity point of view to understand at any given time which of those two things you're doing.
And do you think in the long run you might, when you get going a little bit more over a few years, get more into individual stocks, or do you think that this large disproportion might be the best way to continue?
I think that probably will have slightly more individual stock, but it will vary from time to time. Remember, you're seeing a snapshot as of September 30th, which is a single point in time, so it might well vary over the course of the year. The other point I want to make is that we're very focused on risk. Risk to us, risk is and risk means for us volatility. It means things going up and down very sharply. The way we choose to get our exposure to the stock market, as you've identified, is one that tends to have lower risk, lower volatility.
Well, would like to comment on the half-year report from the Ethical Fund in June this year. It had a section entitled The Evolution of Ethical Investing, and there were some helpful discussions there about different approaches. One of them that was advanced was nudge investing, and it went on to say that maybe AGL could be a test case for nudge investing. Now, I know this gets pretty complicated for everybody else that's maybe not into behavioural economics, but my question was, can Morphic point to any precedents around the world where nudge investing has been applied to fossil fuel electricity generation companies like AGL? That's one question. Are there precedents? Because I have concerns about applying nudge investing to fossil fuel companies.
Well, okay, I'll have a go at answering that if I can. 2 weeks ago, one of my friends and one of our shareholders in Morphic, Mark Forsman, was a keynote speaker at a conference. Mark Fulton, sorry. Mark Fulton. He was a keynote speaker at a conference for the Principles of Responsible Investment, which is and it was a section on the future of investment in fossil fuels. Now, and what Mark will be talking a bit about that in a minute, but the point was that meeting was, a lot of that meeting was about what's called engagement, which is nudge investing. How we can talk to companies about how the end investors, people in this room, feel about the way they run their businesses. In our view, there's two issues here. One is the moral imperative about dealing with greenhouse gases. The other is the economic imperative, which is not to waste shareholders' money. In nudge investing, I think it's very interesting. I think we don't invest in AGL because it's outside our mandate. But I've got to say, I think they've done a pretty good job. I think they're positioning themselves very well for the future. They're ahead of the curve, so they're going to avoid being the last man standing with a coal-powered fire station. They'll probably be the first generation utility in Australia to actually cut their coal. But one of the things that came up at the meeting that Mark was the keynote speaker at was, how do we engage with companies? What's the purpose of it? What do we expect to get out of it? And I think in some cases it's literally asking questions like, what return do you expect to get from this planned investment in this project? And it's very clear that many companies are proposing to invest in projects that on almost any long-term view are going to not produce adequate returns. I think, a case close to home, Mark, correct me if I'm wrong here, was Oil Search. If you look at the slate of projects that Oil Search has committed to, it's quite clear that to our eyes anyway, that they're almost certainly going to not make an adequate return, if any, from those projects, because they all depend on an oil price that we don't think is going to happen, consistent with capping the global temperature at 2 degrees above the base level that's been set by the Paris Agreement. So that's an example of nudge. We want to go and see them. If we were, and we won't be doing it because we don't invest in them, but we think people should be going to see them and saying, please reconsider. We also, but where we're going to be, we've agreed to take part in that nudge process, is in a company that we own in India called Power Grid, which is a power distribution company across Indian states. It's the second biggest power distribution company in the world, and we're going to be asking them to increase their focus on what is their biggest growth area, which is distributing green energy from parts of India where there isn't much demand for energy, but there's a lot of green energy capacity, either wind or solar, to bring it to parts of India where there's very fast economic growth, but they have a power shortage. Now, does this stuff make a difference? I don't really know, but I think it's certainly worth trying. It doesn't cost anything to do it, and I think sometimes, just as we've asked you for your feedback, I think sometimes companies benefit from getting the feedback from their investors. But I don't know. What if I could ask you, what is your concern about nudge investing?
It was mainly that it seems to my understanding of it, to apply in a situation where there's a fine balance between two options. Whereas Matt Grantham, who's done some research on E.ON,
the German company,
electricity company in Europe, that has lost 75% of its capital value when it tried to do what AGL's trying to do. In other words, there's so much at stake. It's heavily into one business, because AGL's still 83% of its electricity is generated from burning coal. So it's not a finely balanced thing for these companies. That they're existentially under threat and likely to go out backwards. So I just wonder about nudge being applicable in a situation where it's not a fine balance, it's very much imbalance.
Yeah, well, I suppose the point, if I might make that, is I think AGL's the value of AGL's business is probably as much as anything in terms of its customer base, its relationships with its customers, and its distribution network. I think, I think that, to be fair, even if you're nudging them to not be a fossil, literally, to be smaller, that's still benefit. And remember, you do that for the benefit of the shareholders. You're saying, please don't waste shareholders' money. In AGL's case, I think they've got the message. They're not going to invest in any new coal capacity. So whether that was a nudge effect from we all like to think when we nudge somebody, we did it. And hopefully it's the case. But I also would give some credit to the AGL board, who I think have been quite proactive in addressing those issues. So we like to think we nudged them, or we don't, but whoever nudged them probably like to think they did it. Maybe they're already on top of themselves. I can't know, but I think it's worth the try.
Yeah, I'm an investor in MEC, and I know more than half our portfolio is in exchange-traded funds. Is that correct?
Yes.
Inherent in that is a management fee, because that's what they do. They charge management fee, and then we pay the company a management fee as well. Do you have any? That's an observation. Any comment on that?
Well, first of all, I mean, we had a question about this before. Why we do that? And I was explaining that we try and add value to you through two channels. One is through buying individual stocks we think are going to do particularly well, and the other is through what we call our top-down view of the world. Which market is going to do better than other markets? How much of the market how much of the fund should be invested in stocks overall? So we use those ETFs for that second part. Now, in terms of the cost of that, we select those ETFs with two factors in mind: cost, how much they're going to cost us to invest in them, and secondly, how liquid are they? How quickly could we change our minds? Now, I'm going to ask Jeff, if you don't mind. Jeff, I mean, we typically invest in super cheap LICs. I would be fair to say. I mean, what
so the cheapest one would be around about 8 basis points of the total fund.
That's 0.08%. Sorry.
0.08%. And the more expensive range would be sort of 30, 40 basis points, 0.4%. So your average drag, like in terms of what we're paying to those managers of those ETFs, would be around about 0.2%. So, if we had half the portfolio in those, then it's half of 0.2%, so it'd be 0.1% drag.
And that's probably too simplistic a view. We actually think we're saving a lot more money than that, because if we look at the way, let's take emerging markets. A lot of our exposure to emerging markets comes through the use of these ETFs. The actual cost of investing in those for us, investing in emerging markets, can be many times higher by the time we're paying for very elevated brokerage, which we don't obviously have to pay in this case, and also for things like stamp duty and so on. Which, I mean, some markets, believe it or not, actually still start to charge stamp duty. Even the UK still charges stamp duty. So we think it's a very effective way for us to get that top-down exposure, which we can move very quickly in a very low-cost way, and that's why we choose to do it that way.
And I had just to add a follow-up.
Yeah.
There's also been some talk about exchange-traded funds, vast amount of money going into them all over the world, and if there's a black swan event, they might be the first ones that are hit bad. Is that?
I think that's a reasonable view.
Yeah.
And so you may say, the reason why I say that is that there are I think I read somewhere, Chad, you're much more up to date and stuff. I think there's now more ETFs than there are stocks in some markets. That's how incredibly. But we don't invest. I mean, that huge proliferation of ETFs is in very obscure things. So there's a lithium ETF, that only invests in stocks engaged in the lithium cycle. Those companies, I think, are very high risk, those ETFs, because what happens is when let's say there's a market panic, everyone wants to rush for the door in an ETF that's only about $100 million in market cap itself, and itself invests in some very illiquid companies. It's going to be very awkward. So the ones we invest in, I said, are cheap and also extremely liquid. So we don't expect that. I mean, Chad, Jeff, can you give me an idea of some of the market cap of some of these ETFs? I mean, I think they're.
I mean, the US S&P 500 would be multiple tens of billions. So the question you raise is a very good one, where the most dangerous ETFs are those where you have an ETF which trades on the stock market with daily liquidity, but the underlying assets they own might take weeks or even months to get out. So the big one is emerging market bonds. So I can buy an ETF today, tonight, and have the trade done within a couple of minutes, and that gets me exposure, say, to some Philippine bonds. Now, to get out those Philippine bonds, you can't do during US time zones for starters, and if the market freezes up, it can be quite hard to get out of. So the big risk that people are concerned about is, in a panic situation, everyone will attempt to sell their ETFs because they think they've got guaranteed daily liquidity, but your market makers, your guys who control this market, will say, right, we're no longer buying those off you when we want to sell them, so we need to unwind these underlying bonds. So that's where the crux of the issue is, specifically around some of these EM and then non-exchange traded products.
Yeah. If I might say, as a general point, every market top, you get a crisis where someone's promising a liquidity they can't deliver. For those of us who are as old as those of you as old as I am, I'm sure there's not many of you in the room. I remember unlisted property trusts which offered daily liquidity. Any of you remember those? They were a complete fiasco because they were investing in whole office buildings and they were promising investors daily liquidity. And suddenly everyone to sell. Well, they couldn't sell the office building. When they tried, they forced the price of office buildings down overall. So it's that mismatch between the underlying assets and ETF. We don't invest in those kinds of ETFs.
With that lack of liquidity to the unlisted property trusts that you just referred to, Was that in the 80s when Westpac almost got wiped out? Is that the period you're referring to?
Let's not pick on Westpac, shall we?
Oh, well.
But yes, I mean, you're right. I mean, I remember in that period, it was about 1990, and going to see an old friend of mine in Melbourne who was running a small bank there, and which was actually quite immune. And he said, he took me to the window and said, "Look at that, Jack." He sort of waved his hand like this across the skyline and said, "That's $1 billion worth of bad debt." Well, it sounded like a big number at that time. No, but that's exactly the period.
So,
Please.
Jack,
So,
just a comment about your
so you come to your
difficulty with the gap between NTA and share price.
yeah.
I was at a meeting a few weeks ago. The chairman there was complaining about the same issue, and probably like yourself, he pointed out that the nature of the company, the size of it, means that you don't have a lot of institutional investors on your share registry, and they saw the way to close that gap was to actually better explain, sell themselves to retail investors. And I don't know whether you've given that any thought, and if you had, whether you consider the associations that you might talk to, like the Australian Investors or Australian Channel Association, presentations either at their local meetings or their annual conferences, where you get to talk to potentially hundreds of people, all of whom tend to talk to other people,
Yeah.
and you will possibly reduce that gap.
I think we will. I mean, this. To be fair, we listed in early May this year. This is the first public event we've had since that roadshow for listing the company. After here, we go to Melbourne, and then we go to Adelaide, and then we go to Perth, and we go to Brisbane. So we have a roadshow, and we've got literally, I think, overall 200 or 300 people coming to see us across all those meetings. So that's part of the solution. I think the other thing is that a lot of investors in listed investment companies want dividends. We were cautious in our guidance on dividends when we launched the prospectus. We've given an update today that we're actually intending to pay our first dividend some 6 months earlier than originally planned. I hope that will start to get a bit more interest and a bit more confidence, because trust has to be earned. We said we're going to pay dividends, but saying things and doing things are two different things. I think once we start to do them, that'll make a big difference. I hope that helps. But definitely, we're please. Irene is all ears on this stuff, and I can assure you she's written down what you said, and we'll try and take up your proposals. So can I just ask Sydney? Sydney was going to ask questions. Sorry.
Just this whole question of ETFs, I'd like to look at it from a different angle. Is your investment in different countries to get country exposure to ETF a long-term investment, or something that you tend to go in and out as it changes?
It varies from country to country. Sorry, was it close?
You know, I haven't looked at all those.
Yeah.
I just came there without looking at anything, so I haven't looked at the ETFs at all.
Yeah.
I don't know if it gives a breakup in which countries they are, which segments.
It does. It's in the annual report, but I'd say that our approach can be sort of like I'll give you an example. I mean, obviously this is more related to the Morphic Global Opportunities Fund, the MEC, because it wasn't around at the time. But in early 2014, we became convinced that the prospect for Narendra Modi to win the election in India was pretty good, and it wasn't being properly priced by the market. We thought it would be very good for the Indian economy in the long term and for the Indian stock market. So we had in this case, we had a fair bit of experience of Indian stocks in the Indian market, but we decided we wanted to get exposure to that idea quickly. So we actually bought some of the US listed, large, non-synthetic ETF in India, which is stock code INDA, just to get ourselves going. And then we thought, well, this is really something big. How can we pick the eyes out of this idea? So we also bought some individual stocks, then we ran down the ETF. So we wanted to move fast. It gave us overall exposure to the market, which we thought would do well. And then, because we had the experience in that market ourselves anyway, we could actually move to get the opportunities we thought were most leveraged to the gains, which in that case were infrastructure related and finance companies financing infrastructure.
So do you see the same sort of thing playing out with these ETFs that you have now?
Well,
that you will move to individual shares if you're more comfortable?
we would certainly balance it, I think. I mean, we take the view that let's say what we don't do, and it must give you an idea of why we do it. If Chad and Jeff and the rest of the investment team and I decide that we really think that Europe's looking great, okay? Some funds managers would say, okay, they'd say to all their analysts, go and find me 7 or 8 really good European companies. And that can take time, so you lose time. You can also make a mistake at the stock selection level, even though your macro view about which region would do best was correct. So our view is that's a really not a smart way to go. It's also more expensive from a transactional point of view. So the smart move to say, make that early decision that you're right about the macro top-down opportunity, and then augment or replace part of that exposure. What we don't do often explain why we don't do things. Often explains why we do things.
Yeah, well, that was my question really, whether it's long term or short term. If you're doing it to get a foothold with an idea to change into stocks where you're more comfortable with something.
Exactly. Well, I think
it's not a long term. Well, if it's a long term with ETFs, then I think there are quite a lot of people who might say, look, I'm comfortable with ETFs generally.
Yes.
In a long term sphere. So, and I think that's what a lot of the questions here have been about. Why ETFs? Because ETFs people are a bit wary about, particularly when they invest through your sort of company to get shares.
Yes, I understand that, but if I might make the observation, funds managers like us, we love to pick stocks, okay? But the truth is, if you do look at any academic studies of what we do, actually, most of the achievement we make for investors, or lack of achievement, comes not from the individual stocks we make, but from the sectors and countries we choose. So we're trying to make sure we don't, fall in love with what we enjoy, or spend our time doing what we love doing at the expense of investment returns. And obviously, we are very conscious about the risks associated with some kinds of ETFs, but we don't choose those ones. We choose the big liquid ones that give us that opportunity to get the top-down view. So I would say that we expect that to be part of our strategy going forward, but you will see changes in the makeup of that because the top-down is where a lot of value is added.
So one last question is China. I think this is the only meeting I've ever been to where China hasn't been mentioned as an area on its own.
I mentioned it until concerts of Japan.
What is your view on China generally? I mean, how much exposure do you have to
how many views would you like? I could probably give it at least 3, and Mark will probably chip in one himself. I'll give you my personal one, then I'll let my colleagues cut in with their views. We actually only have one direct company investment in China. It was made since since the numbers, the table here was put together. It's a fairly small investment at the moment. We just bought 1% of the company, or 1% of our funds in our company. It's a company called China Everbright International. Two of my colleagues are going to go and visit the company next week. And I'm looking forward to them telling me that they're 2 of my most elegant colleagues, and we're sending them out to go and visit a rubbish dump in Shenzhen. It's a rubbish dump with a purpose, though. It's a rubbish dump where they're basically burning the rubbish to create energy, which is an environmentally a very good thing, because rubbish dumped in a landfill is not good for the environment. It's both water and indeed air quality, because it ferments and creates methane gas. And also there's just a shortage of land increasingly in cities in China to actually have rubbish dumps. And as China gets richer, it has more and more rubbish, and the rubbish gets more and more valuable to burn. So they're off to go. This company does waste to energy. That's its primary business. And we want to go along and see and just check some fundamental issues about how it's operating, and also spend some more time with management. That's the only stock we have in China directly. I am always concerned about China, because I do think that there's, I guess it's partly a reflection of my age. I've invested for a succession of economic crises in East Asia, and there seems to be something about East Asia where you have these very fast-growing economies in Japan or Korea, and you tend to have a very government-controlled process to asset allocation and investment. And typically it goes really well while the economies are growing fast, and then when the growth slows, you get all the emerging pressures of over leverage and poor allocation of investments, and often that ends up in the lap of the banks. I mean, you know, Korea was a classic example we can all remember from the late 90s, where, as I wrote myself at the time, Korean banks were more of a funnel. You know, the government instructed money. You know, they collected money from depositors who were forced to save in banks. The money's lent it out as instructed by the government. There was just a funnel. There was no filtering going on, and then it all blew up. My view is at a certain point China's going to have that problem, but I've got to say the Chinese Communist Party is really good at keeping things going, perhaps because they have to, and I don't think it's going to happen overnight. But I'm going to hand over. Jeff looks at China probably more than I do.
So I'll just answer it slightly differently and say, are we worried about China? I mean, that's one of the ongoing things that when you see these interviews with fund managers globally, and people have said, what's the biggest risk out there? A lot of them will often say China blowing up. We're still pretty confident that it's not at that stage. They've got vast piles of US dollars that they've accumulated over the last decade and a half or so. Their monetary policy is on a tightening path, but not that tight. And you've got a government that's very cognizant of trying to move an economy that's driven by essentially industrial historically, and they're trying to move to a more consumer-led economy. Now that is a very difficult move in itself, but given they've got so much ammunition, they can soothe it. So 2 years ago, when they really started putting an emphasis on clamping down on corruption and trying to move to the more consumer-led economy, it didn't quite work, and you had a slowing in the housing market, and a lot of the sort of industrial sector, the old heartland of China, started to slow, and then you had a fiscal stimulus that really ran for sort of 12, 18 months, and we're on the back of that now. So we're kind of on the other side, where people are quite euphoric about China because we've had a very good run. It's probably been one of the best markets to invest in this year. But once again, we've just had the latest plenum. There's a big economic survey coming, or economic forum, in December, where they should say what their GDP target is for the next couple of years. That's likely to be slower again. So once again, they're going to try and start doing what they were trying to do more earnestly 2 or 3 years ago, and it didn't work. So we're not worried about it per se, but given the market's rallied sort of 30% this year, 40% in parts, we're not also that excited about wading in now and buying some of those investments there.
Have you got ETF exposure?
Not ETF.
ETFs, yeah, we do. We're roughly around benchmark, or around what your average global index would be in China. Yeah.
So, and I should say that the direct stock we have there, is very much at the forefront of a major theme for China. And I think, you know, the Chinese Communist Party has one rule: stay in power. And they have what I call neo-Confucianist view, which is they're only going to stay in power while they still have what used to be called the mandate of heaven. And the mandate of heaven is a bottom-up driven consent process. And one of the most pressing issues, if you're in China now, where you've gotten quite a lot richer, not poor anymore, and so you've reached that point in social development where you're most concerned about the environment. So one of the reasons why we think China Over Bright is a very good story. It's all about that area where the people want it to happen, and the government has recognised that in order to maintain the mandate of heaven, they have to make it happen, clean up the environment.
So, what's your outlook on the Japanese yen, and do you hedge your yen exposure?
We're in a slightly different regime. When we launched the fund in 2013 and Arbonomics came in, where they were deliberately running loose monetary policy and trying to get a weak yen to help their exporters, that's kind of a phase that has passed markets now. I mean, Japan is running a strong current account surplus. Back then it was weak on the back of the sort of nuclear reactor fallout, and they were starting to import a lot of energy. So a lot of the structural forces around yen weakness aren't necessarily there. The Bank of Japan has currently got yields pinned. It's quite technical, but they've deliberately targeted a part of their yield curve so that it can't rise. So the 10-year Japanese bond can't go higher than almost zero. That is likely to change next year, I think. And Japan is happy to be behind the rest of the world, but once the ECB start to go and the US start to go, they'll follow suit. So that period of dramatic yen weakness is unlikely to take place.
So do you hedge?
We would hedge, yeah, if we thought it was.
So do
but
you normally hedge the portfolio?
Yeah, definitely. I mean, our default is to be unhedged, but if we were particularly concerned about a currency weakening, that can have dramatic implications for the portfolio return. So in 2013, when we had around about 25% of the portfolio in Japan, it was all hedged. So we really just got that upside of the stock market without giving it all back through the weak currency.
So currently for euro and yen, you think euro and yen would strengthen against Aussie and US dollar?
Well, the main question that everyone's worrying about at the moment is what's going to happen to the US dollar, and then you have relative plays inside that. So I think if you look at the US vote for Donald Trump, it was a very pivotal moment in the dollar market, whereby essentially the US have turned their back on globalization to some extent. So they pulled out of the TPP, they're tearing up the NAFTA doc, and one of the key points of a currency is for it to be a reserve currency and a transactional currency. So essentially they've left a big vacuum in Asia, which China's going to now fill. So renminbi is going to be a bigger traded currency here. And at the same time, you had this beautiful overweight where, because of the European crisis, a lot of people that owned euros, a lot of big sovereign wealth managers, put it all in dollars. They were too scared about the European blow-up. So you've had this large structural position where a lot of people in the world, we meet investors all around the world, and they're all sat on piles of US dollars. They thought it was the safest bet in town. And now they're getting forced to move away from the US, which kind of coincides perfectly with a good vote in France with the Macron win, saying that there's a good chance of European stability. And then at the same time, the US voted for Trump, which is kind of anti-global stability. So you've just got this flow over. So that trend, our view, is likely to continue in terms of US dollar weakness.
One last question. You guys look like you might have some British experience between you guys. So do you think the UK is undersold and the pound is undersold, or there's still Brexit risk? Would you guys invest in the UK if it's cheap?
I think one of the things you'll often hear a fund manager say is, what is our edge? And
excuse me, you're competing with a lot of noise in here.
Yeah, it's very noisy.
Sure. Is there a mic?
There is a mic, but we're not sure it works. Just speak louder, Jeff. You normally do that.
Yeah. Yeah, to be honest, there's so much political risk globally at the moment that we don't see the necessity to then go and wade in and take a view on what's going to go on with Brexit. I mean, one of our favourite quotes is, it's easier to predict 1 million people than it is one. Once you start engaging in politics, essentially you've got debates between a handful of people behind closed doors, and unless you know both parties very well, I'd say at a personal level, it's quite hard to actually predict how they will behave and what the outcome is. In terms of an economy moving into a recession, you've got a lot of big data on that, and you can predict the outcome of consumer behaviour, but we've got no interest, to be honest, in getting involved in what happens around Brexit.
Just to qualify it slightly, sorry, we did have an interest on the day of Brexit. We had a very big interest, and we did actually. We thought it wouldn't happen. We were wrong. We still managed to make money for investors that day. So we do follow that kind of, shock event very closely.
Tina Peridotto from the Fifth Estate. Oh, sorry, thank you. I just wanted to ask, you mentioned China and turning its attention to environmental issues. That's what we cover in our publication. I'm wondering about the impact of environmental investments and sustainability on, in a general level, and how important it's going to become over the next few years.
Okay, well, if I can answer that question in broadest sense, first of all, one of the rules, or the rules of our mandate for our fund, on our ethical charter, which is on our website, is that we try to have at least 5% of the fund, 5% of the fund in stocks we believe are working in some way to make the world a better place. We deliberately define it quite loosely, but at the moment, the companies we list in that category are China Everbright, which I described already, a company called Alstom, which I also described, which is the global mobility company, and a company in India called Power Grid which is basically the conduit for India to move from a entirely coal-based energy system to one that includes a lot more renewables. So those together, those three stocks add up to about 8.5% of our portfolio. We do think that there are going to be some opportunities in these kind of companies that will work to make the world a better place, but they're often prone to becoming wildly overpriced, as everybody thinks it's all going to happen tomorrow, and a classic example of that's probably Tesla, to very depressed. So at the moment, European wind equipment manufacturers are trading at rock bottom valuations because people are now worried that the cost of, or the amount that energy distributors are paying for wind generated power has fallen so low, there'll be less installations, and these companies who have got large workforces making turbines and so on are going to struggle. So you have to, our primary responsibility, and I want to stress this very, is to make money for investors. But our secondary responsibility, we also take very seriously, is not to do so in the way that makes the world a poorer place. So I hope that answered your question, but if you've got follow-up.
I just meant in general as well, in global terms, is it going to become more important, not just for yours?
Look, I think the best test is to say, do we think that the share of world market capitalization engaged in activities that are going to try to make the world a better place will increase or fall? And I think it will increase. As a share, it will increase in two ways. There'll be more companies doing that kind of thing, and there'll be less companies doing bad things. And Mark alluded to coal. I mean, I think most sensible researchers think that the world does not need another coal mine ever. That's
correct.
Correct. Do you want the microphone, or you've got a loud voice?
Thanks.
Accepted.
You mentioned that you like Japan at the beginning or part of your presentation. I was just wondering, because obviously it's got a declining population, but there is one sector that's a clear standout, and that's defence in terms of growing. Are you precluded from your mandates to invest in that area?
Yes, we are. We don't invest in armaments at all. But I want to talk about this declining population, if I can, because you raise a very good point. Demographics are a fascinating thing, and I'm not a real expert on them, but I have studied a bit of them. And let me tell you, I'll make one certain bet. Japan's population doesn't decline as fast as people expect it to do. And the reason for that is that demographics include a huge number of embedded assumptions. One of the key embedded assumptions that Japanese demographers had was that if a woman wasn't married by the age of 25, she wouldn't have any children. So with that working assumption, which had been true for many, many years, they were modelling 10 years ago that the so-called fertility rate, the number of children per woman, would be about 1.24. It's all, I haven't checked the latest things, but I think it's already, because they've had to adjust their modelling for the fact that women are having children, getting married later in life and having children later in life, they've already had to increase their assumptions of fertility rate something more like 1.45, and I suspect it will go higher because Japan was a latecomer to what I might call female emancipation. I'm sure that's an acceptable term. Women have many more choice in Japan than they used to. One of the choices they're making is to work longer, have children later, but they still want to have children. I'm going to leave the microphone down here because I've got a loud voice. Scott, thanks so much.
Does Morphic do its performance and analytics in-house, and how do you measure ESG?
Okay, very good question. The ESG, there are a number of vendors out there, including Bloomberg, who offer guidance about ESG, and we do read quite a lot of them. But I think, looking at it from our primary view is that this is quite a hard thing to automate. In the end, you have to look at it on a company by company basis. My colleague James, who's not here today, has done a lot of work on basically creating questionnaires or checklists that we've developed ourselves to see hotspots, if you like, in terms of governance issues. So we do have access to systematic analysis, but we think that actually it's generally better to do it on a bespoke basis. And one of the benefits we have with our top-down, bottom-up division, we don't have that many. We don't have a very large number of companies, so we can do the work efficiently for that set of companies we have. Well, guys, thank you so much. This has been our first AGM, our first meeting of Morphic Global Opportunity Fund and Morphic Ethical Equity Fund investors in one room. We'll do it again and again and again, probably every 6 months. But I hope that the format works. And if you've got any feedback on the format, please let us know.